I have a confession to make. A few months ago, I was staring at this chart. The data was just terrible. I mean, the company was bleeding cash, the whole sector was down, and the technicals, if you even care about those, were like basically screaming, "Get out."
Yeah.
But I didn't sell. In fact, I bought more.
Oh, no. Don't tell me. Let me guess. You saw a thread on Twitter.
Hmm.
Or maybe a really, really convincing video.
It was a rumor. Someone somewhere said a buyout was coming. And I didn't just buy it. I felt good about buying it. I felt smarter than the market. And then, of course, 2 weeks later, the stock completely tanks. No buyout ever happens. And I'm just left holding the bag.
And you felt like a complete idiot.
A complete idiot. But here's the thing. I think of myself as a rational person.
Yeah.
You know, I pay my bills. I wear a seatbelt. I get basic math. So why? Why, when I open a brokerage app, does my brain just turn to mush? Why do I ignore the hard data for a fairy tale?
You are so not alone in that.
Uh-huh.
I mean, that is the central mystery of trading, isn't it?
Yeah.
We like to think we're these logical operators making, calculated decisions for profit.
Right. Cold and calculating.
But the reality, we're emotional, tribal creatures who just happen to have access to high-speed internet and bank accounts.
So that's what we're unpacking today. We aren't talking about technical analysis. This isn't a tutorial on reading candlestick charts or anything like that. We're looking at the hardware that's running the trade, the human brain.
Exactly. We're doing a deep dive into the psychology of the retail trader, and we're looking at some really fascinating research on these psychological barriers, or hambatan, as the source calls them, that effectively sabotage us.
And what's kind of scary about this research is that it suggests we aren't just making random mistakes. It suggests we are, like, wired to fail.
It's a bit bleak, yeah?
Like our brains are actively working against our wallets.
That's a pretty fair assessment. The research points to 4 very specific mechanisms. And the big theme running through all of it is that your brain is constantly trying to prioritize comfort over profit.
Comfort over profit. That just sounds backwards. Profit is comfort. Profit buys you the comfortable chair.
You'd think so.
Yeah.
But your brain, it doesn't really care about your future bank balance. It cares about your emotional state right now.
Okay.
It prioritizes feeling safe, feeling right, and feeling like you belong to a group. And unfortunately, the things that make you feel safe and accepted are usually the exact things that lose you money.
Okay, that is a heavy setup. So our mission for this deep dive is to drag these 4 mechanisms into the light. I want to know why I bought that terrible stock, and I want to know how to stop doing it.
Let's do it.
All right, let's jump right into the first barrier. The research calls this one the comfort trap, or cognitive comfort over truth.
Yeah, and this is the foundation for everything else.
Yeah.
The core equation here is simple, but it's devastating. When people have a choice between what is correct and what is, soothing, they will almost always choose the soothing option.
So we're not looking for the truth. We're looking for a warm blanket.
Precisely. A warm blanket. We choose what's familiar, what's socially reinforced, and what's emotionally safe. The research breaks this down into a really stark hierarchy. It says rumors beat data.
Okay, hold on. I need to push back on that a bit. I mean, data is objective. It's right there. Why would a rumor, which could be complete nonsense, be more comforting than a spreadsheet?
Because a spreadsheet is cold. It's impersonal. And, let's be honest, data is often boring or confusing, but a rumor feels like a secret. It feels like you've been let into the VIP room. It has a narrative. This company is about to be acquired. That's a story.
That's true. A spreadsheet is just numbers.
A rumor.
A rumor is a plot twist.
And we are addicted to plot twists. Plus, rumors are usually shared by people, which gets us to the second part of the hierarchy. Influencers beat statistics.
Oh, I see this all the time. You'll have this, like, comprehensive statistical breakdown of why a crypto coin is a total scam.
Yeah.
And people just ignore it because their favorite YouTuber with the laser eyes in his profile picture said it's going to the moon.
It's that parasocial relationship, right? You feel like you know the influencer. You trust their face, their voice, their enthusiasm. A statistic doesn't have a face.
Right.
It doesn't smile at you. It just sits there. And it often tells you things you really don't want to hear. The brain just naturally goes toward the human connection, even if that human is
letting you off a cliff.
Exactly. It's wild that we trust a smile more than a solvent balance sheet. But the third one here, this seems like the most dangerous one to me. Certainty beats probability.
This is the killer. This is the one that destroys accounts.
Explain that. Because in my head, I want certainty. Who doesn't want that? Everyone wants it. But the market, it just doesn't offer it. The market is purely probabilistic. There is no, this will go up. There is a 60% chance this goes up and a 40% chance it goes down.
But thinking that way
Yeah,
it's
it's incredibly exhausting. And it's emotionally uncomfortable. The research talks about these things called emotional anchors. When you believe this stock is a sure thing, that belief is an anchor. It holds you steady. You can sleep well at night.
right. I can't lose, so I don't need to worry.
Exactly. But if you adopt a probabilistic framework, if you accept that you could lose at any moment, you lose that anchor. You're just floating in the open ocean. You have
Yeah.
to constantly manage risk, check your stops. It's high cognitive load work.
So we trade the messy, anxious reality of math for the false safety of certainty. We'd rather be wrong and comfortable than uncertain and, potentially right.
Well, ideally, we want to be certain and right. But since certainty is basically a hallucination in the markets, we just hallucinate it. We trick ourselves into believing we know the future because the alternative, admitting we have no clue what's next, is just too scary for our egos.
Speaking of egos, that leads us perfectly into the second barrier. This is about what happens when that little bubble of certainty gets popped. The research calls it belief as identity protection.
Oh, this is a fun one. We see this play out on message boards and Twitter every single day.
I know exactly what you mean. You see someone post a chart suggesting a popular stock might go down, and the reaction isn't, interesting data. It's just pure vitriol. It's, you're an idiot, you're spreading FUD, have fun staying poor.
It's rage. And you have to ask yourself, why? If I tell you I think it might rain today, you don't scream at me, you just grab an umbrella, right?
Yeah.
But if I tell a trader I think your stock is overvalued, they react like I just insulted their entire family.
So why is that? Is it just about the money?
It's rarely just about the money. I mean, if it were just about money, they'd want to know the risks so they could protect their capital. No, the research argues that when someone aggressively defends a bad trade, they're defending three specific things: their past decisions, their ego investment, and their social image.
Okay, let's break those down. Past decisions is pretty clear. Nobody likes to admit they were wrong.
Right. It's retroactive failure. But ego investment is deeper. If you pride yourself on being a smart investor, or if you've made trading your entire personality, well then being wrong isn't just a loss of money, it's a loss of self.
It shatters the mirror.
Exactly. And that ties directly into social image. Specifically, this desperate need to prove I am not a gambler.
Ooh, that hits a nerve. I'm not a gambler, I'm a sophisticated market participant.
That's the line. See, gambling is seen as reckless, impulsive, kind of low status. But investing is smart, calculated, high status. If you admit you bought a stock just because a rumor made you feel good, you have to admit you're a gambler.
And that feels shameful.
Deeply shameful. So, to avoid that shame, you build this massive, complex story about why you're right. You dig in. The research points out this terrifying behavior here. Traders who put like 50% or even 100% of their capital into one position.
The YOLO trade. All in.
Financially, that is just suicide. It's objectively terrible risk management. But psychologically, it's a fortress.
How is putting all your money in one stock a fortress? That sounds like the opposite of a fortress.
Because it forces you to believe. You must believe you're investing, not gambling. You have to convince yourself you've found the holy grail to justify that kind of exposure.
Yeah.
And here's the real kicker. For these people, risk management feels like an insult.
Yes. Risk management feels like an insult. Like setting a stop loss is offensive.
Yes. Seriously, think about the logic. If you were a genius who has found the perfect opportunity, why would you need a stop loss? A stop loss implies you might be wrong.
And your ego just can't accept that possibility.
Correct. So they trade without a safety net, not because they're brave, but because their ego is too fragile to admit they might trip. They would rather blow up the entire account than bruise their ego.
Yeah, it is. Wow. It really reframes that whole diamond hands culture, doesn't it? It's not about resilience, it's about fragility.
It's about protecting a fragile identity at all costs, even at the cost of the money itself.
All right, let's move to the third barrier. We've talked about the individual ego, but now let's look at the group. Herd behavior as risk outsourcing.
This is one where we often get the diagnosis wrong. We look at people piling into the same trade, buying the top of a meme stock, for instance, and we say, oh, they're just lazy, they're sheep, they don't want to do the work.
Right. Do your own research is the mantra for a reason. We assume they're just copying someone else's test because they're lazy students.
But the research corrects us here. It's not about laziness, it is risk outsourcing.
Risk outsourcing. Okay, that sounds more sophisticated. What does it actually mean?
It all centers on this very powerful psychological trick: distributed responsibility. The core feeling is, If we're wrong together.
If we're wrong together. I actually feel that.
Yeah.
There's a weird comfort in sinking on a cruise ship with 3,000 other people versus like drowning alone in a kayak.
That is the perfect analogy.
Yeah.
It minimizes the psychological blow. If you make a unique contrarian bet and you lose,
Yeah.
you look like a fool.
Yeah.
You stand alone in your failure. But if you buy the same popular tech stock everyone else bought and it crashes, well, who could have known?
Yeah.
Everyone lost money, even the experts.
It normalizes the failure. You don't have to feel like a loser. You're just another victim of the market.
Exactly. It reduces psychological pain, it reduces personal accountability, and maybe most importantly, it reduces decision anxiety.
Oh, decision anxiety is real. Just staring at a blank chart, not knowing whether to buy or sell. It can be paralyzing.
And the herd solves that paralysis instantly. The herd screams, "Run this way." And suddenly you don't have to think, you don't have to weigh the odds, you just run.
But here's the problem. In the wild, running with the herd saves your life. If the herd is running from a lion, you should definitely run too.
Correct. In biology, herd behavior is a survival mechanism.
Yeah.
But in the markets, it's a slaughter mechanism.
Because if you're running with the herd in the market, where exactly are you running to?
You are usually running directly into the waiting arms of the smart money who are selling to you. The research has a great term for this. Becoming exit liquidity.
Let's explain that term for anyone who hasn't heard it. Exit liquidity.
Imagine a large institution wants to sell 1 million shares of some stock. They can't just dump it all at once, or the price would crash to zero. They need buyers, lots of them.
Right.
They need a stampede of enthusiastic retail traders to come running in, buying up those shares at really high prices.
So the herd isn't protecting you. The herd is the meal.
The herd is the meal. The smart money needs the herd to feel safe and confident so they can unload their positions. When you join the crowd because it feels safe, you are essentially volunteering to pay for someone else's profit.
That is dark. We're outsourcing our risk to the group, thinking the group has our back, but the group is just a bunch of other scared people holding hands while they jump off a cliff.
And just hoping that because there are so many of them, gravity won't apply this time.
Man. Okay, let's get to the fourth and final barrier. This one feels like the most technical, but also maybe the most critical. Narratives versus mechanisms.
This is really the battle for the soul of the trader. It's the conflict between what our brains crave, which is stories, and what actually drives the market, which is mechanisms.
We love a good story. Heroes, villains, good versus evil. But you're saying the market doesn't work on stories.
The market could not care less about your story. The market runs on dry, technical mechanics. The research lists things like liquidity, absorption, entropy, and non-entry conditions.
Okay, we need to stop and unpack these because these are words that make people's eyes glaze over. Let's start with entropy. What does physics have to do with my stock portfolio?
Well, entropy is just a measure of disorder or randomness. In the market, it means that a lot of price movement is just noise. It's random. It isn't some secret signal. It's not hidden pattern. It's just motion.
But the retail trader looks at that noise and sees a picture.
Exactly. We look at random static and we see a face.
Yeah.
We invent a reason for every single tech. Oh, it dropped 10 cents. That must be the news from China. No, it dropped 10 cents because of entropy, because it's a chaotic system.
Okay, what about liquidity and absorption? These sound like plumbing terms.
They essentially are. Think of absorption like watching paint dry. Let's say a big player wants to buy a huge position. They don't just click buy. They sit at a specific price level, and they just passively absorb every single sell order that comes in. The price doesn't move. It just goes sideways for days, maybe weeks.
And that is incredibly boring.
Is deadly boring. Nothing is happening. There's no drama. So the retail trader gets bored and leaves. They go looking for something that's moving fast.
And that's where they get hurt. Because the boring part was the accumulation.
Right. And then you have non-entry conditions.
Which means what it sounds like.
Knowing when not to do anything.
That is the hardest thing in the world. I feel like if I'm not trading, I'm not working. I'm missing out.
That's the narrative mindset. In a movie, the hero is always doing something. He's always fighting, running, shooting. He never just sits on a couch for 3 hours waiting for a phone call. But in trading, the professional might sit on their hands for weeks because the conditions aren't right.
So mechanisms require patience, boredom, and critical thinking. What's the narrative alternative?
The narrative is what retail traders actually want. They want smart money versus dumb money. They want the big short. They want to be the scrappy underdog fighting the corrupt hedge funds.
We want to be part of a movement. We want to stick it to the man.
Exactly. And the research makes this brilliant distinction here. Mechanisms require thinking. Narratives require belonging.
Narratives require belonging. Wow, that explains the whole meme stock phenomenon perfectly.
It does. When you trade based on a narrative like, we're going to squeeze the shorts and take this thing to the moon, you're not analyzing a balance sheet. You are buying a membership card to a social club. You're paying for the feeling of belonging to a revolution.
But the market isn't a revolution, it's a machine.
It is a cold, unfeeling machine that just redistributes wealth from the emotional to the disciplined. If you are trading to feel like a hero or to feel like part of a tribe, you're bringing a screenplay to a physics exam. You are going to fail.
You're trying to be the main character in a movie, but the market is just an engine that needs fuel. And you're the fuel.
That's a brutal way to put it, but yeah. A mechanic fixing an engine doesn't hate the engine. He doesn't love it. He doesn't invent a story about how the engine is evil. He just understands how the pistons work. He fixes it, and he goes home.
So to really succeed, we have to become that boring, lonely mechanic.
You have to learn to embrace the boredom.
So let's recap what we've uncovered in this deep dive. We've got 4 major barriers stopping us from being that rational mechanic.
First, the comfort trap. We prioritize soothing lies over difficult truths. We'd much rather trust a friendly face than a cold spreadsheet.
Second, belief as identity protection. We wrap our self-worth into our trades, and we refuse to manage risk because a stop-loss feels like admitting we're not a genius.
Third, herd behavior as risk outsourcing. We follow the crowd just to avoid the anxiety of making our own decisions, not realizing the crowd is usually running off a cliff together.
And finally, narratives versus mechanisms. We get addicted to the exciting story and the feeling of belonging while totally ignoring the boring technical reality of how price actually moves.
It's a pretty comprehensive map of how we self-sabotage.
It really is. And I have to ask, knowing all this, does it ever go away? Do you ever stop feeling these urges?
I don't think so. I mean, we're human. The urge to follow the herd or believe a good rumor is biological. It's hardwired. You can't just delete the software.
So what can we do?
You can build an override switch. You can develop self-awareness. The next time you feel that surge of anger when someone questions your trade, you just pause. Recognize it. Say, that's my ego trying to protect itself.
Or when you feel that FOMO, that excitement because everyone on Twitter is chanting the same ticker symbol.
Exactly. Catch yourself. Ask the question. Am I buying this because the liquidity absorption pattern suggests accumulation? Or am I buying this because I want to be part of the party?
Am I looking for profit or am I looking for friends?
That is the ultimate question.
And I think that's a perfect place to leave it. But before we go, do you have one final thought for everyone listening to mull over?
I do. It's a bit of a mirror test. I want you to look at your trading history. If your trading feels emotionally soothing, if it feels exciting, if it feels like you're part of a really fun story with clear good guys and bad guys, you are almost certainly the sucker at the table.
Oof. That hits hard.
Real trading, the kind based on mechanisms like entropy and probability, it should feel like hard, lonely work. It should be boring. It shouldn't feel like a party. If it feels like a party, you're not the host. You're the entertainment.
A sobering thought, but a necessary one. Thank you for helping us navigate the messy psychology of our own brains today.
My pleasure.
And thank you for listening to The Deep Dive. Go check your emotional anchors, and we'll see you next time.